Hello and welcome, everybody. Happy Friday. I hope everyone is having as lovely of a Friday as the market is. It's been a crazy week in the market and an even crazier week in sector rotation. For more information on that, stay tuned for our newsletter, which will be coming out next Monday. But there was some massive changes in sector relative strength, as well as sector relative strength right now is the lowest it's been since we've started Sectors Made Simple. So, a lot of crazy stuff going on with the market. But today I want to talk about something different. Last week we talked a little bit about analysis, market analysis, fundamental, technical, words, numbers, all that really good stuff. But there's only so much that information can do for us. At a certain point, that information needs to become something we can use to invest. So that's where this idea of trading strategies comes in. Trading strategies are a way to take information and use it to create find investment opportunities. Now, there's no right answer, there's no single answer, there's only your answer. So today, I want to talk a little bit about what trading strategies are, what some examples look like, where they're helpful and where they're not, and then go into a couple of things that we're doing here at Sectors Made Simple to make creating trading strategies and using trading strategies that much simpler. So, that is the topic for today. Let's say hello to everyone we have with us before we get into the presentation. Hello, Meli, Vero, Kike, Mao. Hello, Mao. It's good to see you. Evelyn, Blaze. Blaze, I need you. Can you send me an email, please? I need to talk to you. Thank you. Sonia, Romulo, Yenika, Andrew, Elizabeth, Chela, Kira, Eddie, Maida, Pablo, Lucia, Roberto, Mario, Juan, Irma, Dani, and my mother. Welcome, everyone. Hope everyone is having a lovely Friday. I'm going to take a drink of water, and then we're going to get right to it. Alrighty. So today's conversation is all about trading strategies. As with many of these conversations, well, it would help if you could see my screen. So let's get that up and going. Ta-da! So, trading strategies. They're something that many of you are familiar with, but I want to just make sure that everyone has the same starting knowledge, the same baseline. So, first things first, what is a trading strategy? A trading strategy is, I like baking, so I'm going to use this example. It's like a recipe. It is how much flour do you need? How many eggs? How much butter? How much sugar? There's no such thing as too much sugar, so a little bit more sugar. But it's this idea that you can take a bunch of different ingredients and create a cake, a muffin, or some money out of it. And these trading strategies can be very simple. For bread, it takes 4 ingredients: flour, water, salt, and yeast. That's all it takes. So other recipes can be a little bit trickier. They require a little bit more stuff. So it doesn't mean that it's not a trading strategy. A trading strategy is anything from the 4-ingredient bread to the most extravagant cake you can imagine. And these strategies will give us different things. Some strategies can be as simple as telling you, is it a red light or is it a green light? Is it stop or is it go? Or in words that I'll be using throughout this presentation, a go or no-go decision. Do you invest? Go. Or do you not invest? No-go. While other strategies may help us to find companies or opportunities that are worth investing in. And these are usually what are called screeners. It's a way of creating a bunch of yes or no questions that helps us to find our investment opportunity. Now, something important to note here is that strategies are different than analysis. Now, that's not to say that they're completely different because a lot of strategies use analysis, but they are kind of different. So let's talk about that. Let's figure out where they're the same and where they're different. So analysis is a way of finding the value of a company. How much is a company worth, and is it overvalued or is it undervalued? So for this, there's two main types of analyses. Fundamental analysis, which uses a company's earnings or the value of a company to find which companies are worth investing in and maybe not so much. Technical analysis uses price history. How was its price last week? Has the price been growing over time? Is the price flat or is the price going in the toilet? All of these are examples of technical analysis. So we have fundamental, which is, does the company have good values? Are they a strong company on paper? Then technical analysis is it a strong company for dollars and cents? Does the price make sense? And analysis gives us an idea of how strong an opportunity is. So all it says is, it doesn't say go or don't go. It says, okay, the weather is pretty nice today. That doesn't help me if I'm at a traffic light and I'm trying to figure out red light or green light. So that's where analysis is not so great. It's not so great at telling us, is this a yes or a no to do I invest in it? All it does is it tells us how the value of the company is different than the market or different than another company. So strategies are slightly different because they may use analysis as part of the strategy. But instead of saying, what is the value of the company, you may say, is the value above 15? Yes or no? So turning a big open-ended question into a yes or no, for example, Kira, how are you feeling today? She may say, I'm feeling 50% happy, 25% sad, and maybe 25% hangry. That doesn't help me. I need to know, are you happy? Yes or no? Of course, her feelings matter. We love her feelings. But I'm coming up with examples. Bear with me here. So strategies are yes or no questions. Analysis are the how do you feel questions. So strategies come from a long list or even a short list of go or no-go decisions. Yes or no kind of questions. And these strategies, instead of it just being how good of a company is Tesla, it's do I invest in Tesla? Yes or no? That is the kind of thing that trading strategies will give us. And because they're very easy to say yes or no, we can do something called backtesting. Fancy word for saying, if I had traded like this my entire life, how would I have done? Because coming up with a way to trade is nice. Knowing that that way to trade would make you money, much better. So backtesting lets us do that. We can see how our trading strategy would have done in the past week, past year, past 2 years, so on and so forth. But that requires us to have those yes or no's. because really we're just building a robot here. We're trying to create something that can trade for us. So how do we create something, not to make a robot, but how do we create something that we can use? So it's pretty straightforward. Let me just, I think the formatting on this is kind of wonky, so I'm just going to go ahead and do that. Okay, we're going to go line by line. So the first thing that we need to do is we need to decide how often are we going to invest. The best trading strategy is one that it's not you have to check it every day, it's you check it once every so often. It may be a day if that's how you want to invest. It may be every hour, but it could also be as long as you check it once a month. Now, the next thing is, do you want to have that red light, green light, that go or no-go decision? If you want that go or no-go decision, you need to figure out what that number is, which is the traffic light that you're looking at. So that may be something like, is the S&P 500 over its 10-month moving average? If yes, then pass go, collect $200. If no, stay here or do something else. So if you're not using a go or no-go decision, then the next step is to find your set of questions. And these questions should always end in yes or no. So we may end up having a list of 5 questions, for example. It may be, is it sunny outside? If I'm trying to decide if I should go for a hike. Is it sunny outside? Yes or no. Have I already worked out today? Yes or no. Am I in the mood to go for a hike? Yes or no. Is the trail muddy? Yes or no. All of these are yes or no questions that if yes, then I go for a hike. And after we've created this, we can now make our little robot. We can have our robot go in and trade how this strategy would have it trade over the past month or even years to see how that strategy would have done. Then we know, okay, well, had I used this strategy, I would have made $4,000 in the past year. We go in, mess with the robot a little bit, tweak some things, pull out some wires. Nope, not that, the other wire. Then we test it again. 4,000 becomes 6,000. Okay, we're getting somewhere. That is how trading strategies are created. It's not your first try at it, you're going to find the world's best trading strategy. You are probably going to go through many different strategies to figure out the one that works, but most importantly, the one that works for you, how you want to trade. Different strategies will have different risks and different returns and all of that. So sadly, as much as I would love to say investment strategies are the only thing in investing you ever need, it's not true. There are some drawbacks, some not so great things about trading strategies or investment strategies. So I want to make sure that we understand why they're good, but also why they're not so good. So the reasons they're great is that investment strategies make decision making and finding investment opportunities faster and easier. It can be as simple as you create a screener, you go in, look at the screener, buy anything that's on the screener, see you next month. That's a trading strategy. But you can also create trading strategies that can be tested long term. You can see how these strategies would have done to know, okay, over the past 5 years, I would have made 20% more than the market. That's nice to know. You know that your strategy is very good. or you tweak some things, and now you're not just comparing the strategy against the market, you're comparing the strategy against your old strategy. So it's really nice to be able to see how these strategies change, and as you change them a little bit, tweak the different numbers, the profits or losses, well, hopefully profits, we like profits here, the profits will increase as you get that strategy better and better. And technical analysis is, well, technical analysis, fundamental is fundamental. But strategies, they can use technical, fundamental, or a little bit of both to make informed investment decisions. It's very powerful to be able to use fundamental analysis and technical analysis and put it together to create a strategy that you know the company's price is good, but also the company itself is good. So that's why investment strategies are great. Why are they not so great? Well, the first one is that the market changes every single day. Tomorrow's Saturday, but on Monday, we have no idea what the market's going to do. So because of that, our strategy may not be the best thing for Monday. And we have no idea of being able to tell how good it's going to be until we've already gone through the trading day and now we're having our evening dinner and looking back at the day. So how was the day in the market, honey? And we say, oh, well, I made 5%, lost 5%. You don't know until it's already behind you. So market changes can happen, do happen. And the strategies need to change as the market changes. But how do we change it for the better is a hard question to answer because no one really knows. The farther out you have to think, the harder it's going to be to predict it. So the second thing is that it's very hard to find a difference between a failed strategy and a bad period in the market. I'll go into some examples in a little bit here. But like I said, it's very difficult to know, did I have a bad day or is the strategy that I'm using just wrong? Because the market, changes. What worked yesterday hopefully will work today, but may not work tomorrow. But it's not easy to say, is it because the market didn't have a good day? Or is it because the strategy is no longer good? And there's no right answer here. And that's one of the challenges, is you get very comfortable with the investment strategy that you use. That's why we like them. They're easy. They take the thinking out of it, and they think for us. But that thinking never changes. The market does. So at a certain point, that strategy may turn back into a pumpkin, and you're not going to get anywhere with a pumpkin. We need a carriage. So it's hard to know, did we just hit a bump in the road, or has our carriage turned back into a pumpkin? And then the third one is a new term for many of you, which is called sample selection bias. Let's go into that in a little bit more detail because it's probably not a familiar term, but the idea of it should not be a surprise. Sampling bias is something that happens when we backtest strategies. I have a saying, statistics never lie, but liars use statistics. Think about it like this. I take a coin and I flip a coin 100 times. You would expect over those 100 times, 50 would be heads, 50 would be tails. What if someone doesn't like me very much and they want to say, Jonathan cheated? What they could do is they could go in and find 10 coin flips that I did that all of them were heads. It's not real. Of course, I flipped a coin. It's going to be 50-50. But because they chose this one very specific part, those 10 coin flips, maybe number 25 through 35, they can make it look like I cheated, even though I didn't. So, sampling bias is this idea that depending on how you look at the situation or where you choose your dates, for example, it will change the outcome of your testing. To put it in different words, when you create a strategy, you have to say, when you backtest, since March of 2020 to today, I beat the market. That's great. But if I changed that 1 year to the past 6 months, all of a sudden, the market kicks my butt. And the reason is, it's not that I made up information, it's that those first 6 months I did very well. The last 6 months I didn't do so well. But because those first 6 months were so good, it makes it look like we were doing well the entire time. So let's go a little bit into this. So let's talk about a couple of different real-world examples of sample selection bias. These can happen with the market changes. It's very difficult to say, was I making money because I was investing in good stocks? Or was I making money because after the pandemic, most stocks were doing better. Most stocks were improving very quickly. One person could look at it and say, I made 30% in a year. I'm a great investor. Another person may look at it and say, the market made 30% in a year. I was along for the ride. The next one is the example that I gave before, where we choose too long of a period of time or too short a period of time. My strategy may have made me a ton of money in the last week, but the week before, it lost me a ton of money. If I only look at that 1 week, it looks pretty good. When you look at the entire thing, it's a different story. But at the same time, you can look too big and miss what's happening right here. So there's this whole issue of looking at too much information and not enough information. And then the last one is what's called survivorship bias. This is the idea that why do you not see a lot of really bad restaurants? The reason is because the bad restaurants don't last very long. Bad companies don't last very long. So the idea of if we want to do a back test over 15 years, the only companies we're looking at are the companies that have survived that 15 years. What about the Fry's Electronics? What about the Blockbusters? These are large companies that have sank because the times changed and they couldn't keep up. So this happens when you're looking at strategies. You're only going to be looking at companies that you could trade today, right? That's the point of a strategy. But if you're running a test for the past 20 years, suddenly those companies, some of them may not have been around that long. Some of them, maybe there was some companies that used to be part of the strategy, but are no longer part of it because they crashed and burned. It's difficult. And again, there's no right answer here. There's no magic solution to survivorship bias. It's just something that is always going to be there. So, because of this, bias is not something to fear. It is impossible to eliminate bias entirely. But it is very important to think about bias when you create your strategies. Don't just test a strategy over the last week. Test the strategy over the last month, over the last year, over the last 5 years. And make sure that you're comparing what you're creating to the market, to an ETF, whatever it might be. Compare it to something. So now I created a strategy. I like it. How do we say if it's a good strategy? It depends. I wish that there was a simple answer, but there's no simple strategy. There's no simple answer. Because there's many ways to say if a strategy is good, but here are some of the most basic questions that you can ask to see if the strategy is good. Did the strategy make money? Well, if it didn't make money, why are you even thinking about investing with it? Once you know that it made money, did the strategy outperform the market? Because there's this idea of opportunity cost. If I go outside for a run, what do I lose by doing that? I have to give something up to do something else. So by investing with my strategy, I didn't just put all of my money into SPY, the S&P 500 ETF. I could have just put my money in SPY, wiped my hands clean, and I would have probably made some money. But the strategy may have done better, or it could have done worse. It could have still made me money, but I would have done better had I just invested in the market. Then another question to ask is, did it just have one good year, or was it consistent? Was this strategy something that did very well and just kind of went up and up and up and up? Yeah, this is the right direction. Up and 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 up. Or did it have one really good year and then went into the toilet and kind of has been going up since? It's important to know because, like I said before, a strategy that is more consistent doesn't make you more money, but is more consistent, might be the better option because it's not going to make or break your portfolio in one day. It's going to be less likely to have that bad day, week, even year for some of these strategies. So it's important to know if that strategy is something that would do well in the 1 year, or do you have to wait 10 years? And then the last, but in my opinion, the most important question of them all, is the strategy still performing well today? It's great that you can tell me a trading strategy that would have made me 100% return in 2018. But this is 2021, baby, and we need something to invest today. A trading strategy is not very useful if you can't use it now. So, is the strategy still performing well today is a very important question to ask when you're deciding, is this the strategy that you're going to follow? And the last thing is not so much a question, but is something to keep in mind. If you're backtesting, you're creating a robot, and you're teaching that robot how to trade. But you're a human. You are smart and can think. You can look at two opportunities. And instead of just saying, I can only take one or the other because I am a robot, you can say, you know what? They're both great options. Why don't I buy both? Or you could look at an investment opportunity and say, you know, I like this, but I'm going to check tomorrow and see how it's doing. You can do that. For a robot and for backtesting, a strategy is the only thing it knows. As a human, you have the option to use it as a guideline, not as your safety net or as the only thing you know. So remember that you're human, and a trading strategy is great, but you're greater. So you, with a trading strategy as a guide, is a very powerful investment tool. All right, I'm done talking about humans. I want to now talk a little bit more about robots. I like robots, but the one thing I like more than robots is machine learning. I love AI, and I think that it's something incredibly powerful because it's accessible to many people, but is incredibly powerful when it's put into some application, when it's used for something. So a lot of money has been poured into machine learning and building the perfect trading robot. So the question of, well, is there a perfect trading strategy? What is the perfect trading strategy? Well, it's a multi-billion-dollar question. And because of how important trading strategies are, investors, and by investors, I mean hedge funds, banks, institutions, all of the big hippos, have spent billions of dollars trading AI to trade. And some of these strategies are good, but as I said before, the farther into the future I have to think, the less confident I am. Robots are the same way. If they have to think 5 days into the future, they're not going to be very useful. So instead of trying to predict if a stock is going to go up or down in the next week, what if I just predicted if it would go up in the next second or the next tenth of a second? That is where most of this machine learning has been put. Many trading strategies have come from machine learning and use machine learning, but the most successful ones use something called high frequency trading, HFT. HFT, or high frequency trading, is a robot that doesn't just buy and hold for a couple of days. It buys and then sells and then buys and then it sells and buys and sells thousands or hundreds of thousands of times per second. These things trade like I would say like animals, but animals can't trade that fast. We're talking thousands of trades in the time it takes me to snap my fingers. And they're not trying to make $100 per trade. They're trying to make a couple of cents. But if you make 5 cents on 100 trades in a second, well, 5 times 100, that's $5. That's $5 in 1 second. That is where high frequency trading is king. Not at predicting the market next week, but at predicting the market in a matter of seconds. Not even seconds, milliseconds. It's gotten so bad that real estate, keep in mind, New York Stock Exchange is a place in New York. And rent or real estate in New York is a little expensive, But the real estate around Wall Street is stupidly expensive. And it's not because they like having an office with a view of the bull. It's because they'll take a giant computer, stick it right next to the stock exchange. Because if they can get that information 1,000th of a second faster than their competitor, well, because they're making thousands of trades a second, that's going to result in a lot of money. If they can beat all of the other robots that maybe have a couple of milliseconds more delay, that's pretty good. Just to give you an idea, the connection from me to you, it's about 75 milliseconds, or 75 thousandths of a second. These high-frequency traders, 1 millisecond, 1,000th of a second, results on average in $1.5 million of additional revenue when using a high-frequency trading algorithm. That's some pretty expensive data speed. So, unfortunately, I don't have an office in New York. I don't have a supercomputer. I have a webcam, and I have the Matrix. But that doesn't mean I can't create very useful and very powerful trading strategies. So I want to go through some examples with you. I want to talk about some different strategies that use the different topics we've covered so far. Now, before I go anywhere, I need to say this. These examples are for educational purposes only. I am not recommending that you take this strategy and go use it and say, hey, Jonathan told me this strategy. I want you to see these as examples of strategies that exist. There is no one perfect strategy. The perfect strategy is the strategy that makes sense to you and that you can use to trade your way. And of course, past results can never guarantee future performance in the market. What worked yesterday might work today, but we don't know if it will work tomorrow. So keep that in mind, that there is no magic answer. And all we're trying to do here is see what options we have. So, first thing to start with is technical analysis strategies. Very, 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 very simple. Strategies can be as simple as, well, a go or no go. When do I buy? Yes or no, rather. Do I buy? Yes or no. Or do I sell? Yes or no. Technical analysis gives us an answer to this very question. And here's an example of that. A buy signal for point and figure charts is just a double top breakout. Is our current column of X's above the previous column of X's? Yes or no? Ta-da! That's a trading strategy. Or when do I sell? Well, is the current column of O's below the previous? Yes or no? Ta-da! That's as simple as it can be. And this is a kind of strategy where all of the information that you would want to find for it is on a free website, stockcharts.com. Now, let's use a little bit more complicated of an example. Let's use a strategy that has that go or no-go thing. The example that I want to use is a sector rotation strategy by a guy named Meb Faber. Many of you have probably heard me talk about him before, but he is a person that wrote an amazing trading strategy using sectors and looking at market sectors. But he doesn't just say, what is the best sector buy that best sector? He says a very straightforward trading strategy. You invest on the last day of every month, so a 1 month rebalance period. So right now, he would not even invest until the 31st of March. On the 31st of March, he goes in. See you next month. And his go or no-go is the S&P 500 above the 10-month simple moving average. If the S&P 500 is not above the simple moving average, sell everything, hold cash, stick it underneath your mattress. If the S&P 500 is above the 10-month moving average, then go in and buy the top 3 sectors with the highest 3-month returns. That's it. That's his entire strategy. And he did backtesting for this. He backtested it 80 years and found that this strategy outperformed the market by about 10% per year over 80 years. Now keep this in mind. He says himself that this strategy does not make you money every year. It will underperform the market many years. So this strategy can have good years, but it can also have bad years. And that goes back to some of what I was talking about before with the bias. You may get scared off because a strategy has a bad month or even a bad year. That doesn't mean the strategy is not good. It just meant that it's not good in that period. So if you want to learn more about this, I encourage you to head over to Stock Charts. In the chart school, they have Meb Faber's article on what the strategy is and how you can use that strategy with stock charts. All of the information to do this is on Stock Charts. So, of course, Stock Charts like saying, hey, check out this trading strategy. You can do it here. Now, I want to talk about something a little bit closer to me and my family with a screener strategy example. A strategy where it's not going to give you that go or no go. It's just going to give you a list. The list of companies that check all of the boxes. Every single one is a yes. We like this stock. It's going to end up on the list. If any of you have heard of this financial educator named Julie Stav, she came up with this amazing list of requirements called Be a Profit. Be a Profit, every letter stands for a different yes or no question. Is the beta less than 2? Is the earnings per share greater than 25? Is the market in an uptrend? Is the company's price to earnings ratio above or below the industry? Return on equity above 15%? Is the stock price in a column of X's? Is the float shares more than 50 million? Is the institutional investors greater than 10% or 1%, less than 95%? And is the price within 10% of its high point? It's a lot of information, but each letter stands for a different check. And some of these letters are fundamentals like beta, EPS, price to earnings, return on equity, float, institutional investors. And then others are technical. Atmosphere, is the market price going up? Outstanding performer, is the price compared to the market, or is the price compared to its sector going up? Then top dollar, is the price within 10% of its highest year price? So we have here the marriage of fundamental and technical analysis in one strategy. But funny enough, even Be a Profit still has a kind of go, no go idea. And it's the A, atmosphere. Atmosphere is the market. Is the market in an uptrend? Is the market improving? Because if the market's not improving, the strategy is going to tell you that it's better to not be investing, or it's better to be holding cash. You want to be investing when the market is improving. So that's Be a Profit. And it is a little bit of everything. Fundamental analysis, technical analysis, and even a little bit of that go, no-go kind of decision. For the sake of continuity, I want to share with you all where you can find information for Be a Profit. Two main places, FinViz and stock charts. On FinViz, you can find beta, earnings per share, price to earnings, return on equity, shares float, institutional ownership, and top dollar. On stock charts, you can find the atmosphere, which is the S&P 500, and the outstanding performer, which is the company compared to its sector. If you want to learn more about this, I gave a full webinar on this kind of analysis on Be a Profit and how it can be used with the matrix. It's members webinar number 2. So if you're interested to learn more about this, members can check out that webinar. And now, because after all, this is Sectors Made Simple, and why would we have made a company if there's not something that we can provide that others don't? Well, it's because the matrix can be used to create trading strategies as well. The matrix is not just an analysis tool. It's not just a way of seeing where the strengths in the market is, but it's a resource to create strategies. And because of how the matrix has been created, we can use different parts. We can use the momentum. We can use the actual matrix. Or, coming soon to a computer screen near you, you can even use BPI as part of your investment strategy. And not just that. What good is a strategy if you can't test it? So we have built a backtesting engine that I'll show off here in a couple of minutes that will let you see how your strategy would have done over the past year, 5 years, so on, to see if that strategy is a winner. I'll prime you guys for this right now so you can get the thoughts turning and then type in any examples you want to see. But for those that are members and will soon have access to the backtesting, or for those that aren't members but want to see what it's all about, give me a trading strategy using the matrix. And after I finish up these slides, there's 2 more, well, 1 more after this one, I'll go to the backtesting engine and test the strategy you want to see. So if you have a strategy that you want to see tested, let me know the dates and the strategy. And we'll take a look to see how well that strategy would have done. But here's the real beauty and why I've taken so much time to go through these different examples. You can use all of them. You can use a market indicator of a red light, green light, go or no go situation. So you could say, I will only invest if the S&P 500 is above its 10-month simple moving average. When it is, I go to the matrix to find the top sector. Then I go to a screener and find companies in that leading sector that have Be a Profit. And out of those companies, I use technical analysis to find companies that are on a buy signal. It takes a lot of information but turns it all into very simple steps. Is the market good? What's the top sector? Best companies in that sector? Are they on a buy signal or not? Done. That is an example of a trading strategy that uses a little bit of everything, but can result in some very good success. Nothing is ever promised, but the more information you use, the more informed your decision will be. Now, let's go take a look at the backtesting engine, shall we? Does anyone have a strategy that they want to see tested? If not, I will go through an example of a strategy that I have. All right, let's see. I am going to test for the past year if I invest in the top sector once every 2 weeks with an X count momentum of 2 or more and a positive trend of 5 or more. Oh, Erica, you have a strategy. What strategy is it? Dímelo. So, right now what I've done is I've told it for the past year, I want to see a strategy that uses, if I go to the dashboard, uses the previous matrix, uses the 1 week ago matrix, or momentum, my apologies, with the positive trend. And I can click run backtest. And I can see that my strategy outperformed the market. The market is here in a black line. Our strategy is here in a green line. Not bad, right? We did pretty well. We beat the market. But let's change this, shall we? Let's go back to that idea of sampling bias. What if I change March to September? Now we see a little bit different. We still see that our strategy is outperforming the market. But during this period here, it didn't do that. And then during this period here, it 100% would be beating the market. So let's try one more thing now. Let's see what happens if we remove the positive trend. Now we see that strategy would have done worse here, better now. What page am I on? This is the backtesting for the matrix. This is not available to everyone yet, but it will be in 2 weeks. So everyone that has a Sectors Made Simple subscription will be able to go in and test strategies for themselves over any period of time that you want to test within reason. I think it goes back 6 years, 7 years-ish. But you can test a strategy for yourself, and there is no limit to the number of back tests that you can do. As many strategies as you can think of, as many date ranges as you want to see, you can test. All right, Erica had a strategy. 5 years back, the top 2 sectors on positive trend only. All right, let's do it. 2017. And you said positive trend. Was there a specific number? I'm going to set it to 5 just as something, and then we can decide what to go from there. The top 2 sectors. All right, 5-year back test using the positive trend of 5 or more. Rebalancing, so investing every other week. It's going to take a minute. There you go. So that's how that strategy would have done. We see that it used to do about the same as the market, but since COVID, the market has steadily outperformed that strategy. So let's zoom in on this a little bit. Let's go just the past year to see how that strategy is done. So it's not as bad as what it had originally looked like. We can see here that the strategy still underperformed the market, but did pretty well. So it still would have made you money, but not as much had you just invested in the market. Lucia wants to test a strategy. Top 3 sectors with X counts every 2 weeks for the past 6 months. Lucia, what number do you want to see for the X count? And I'm assuming you mean momentum, correct? So September 4th. X count, momentum. And every 2 weeks. And this is using top 3 sectors. There you go. You can see that it outperformed the market. It didn't outperform the market until about mid-November, but then it outperformed the market and continued doing well since. And the cool part about this is not only can you see how well it did, but every time it invests, you can see what it bought and sold, as well as how it did compared to the market. Here under strategy return, you can see if the strategy made or lost money. Under SPY return, you can see what the market did, and then return difference is how much better or worse we did than the market. You can see here, if there is not 3 sectors for it to invest in, it will only invest in 1, or 2, or 3. So again, back testing is incredibly valuable for finding strategies because it lets you see how your trading robot would have done. This backtesting engine will be made available to all Sectors Made Simple subscribers for no additional cost in about 2 weeks. When we release it, I will go through a little bit about it, but I encourage you all to go in and try some strategies for yourselves. Find the strategy that maybe worked long term, or maybe the strategy that is doing the best today. There is no right answer. There's only the right answer for you. X count of 3 or more every week, only momentum. Let's do it. So X count, momentum, 3 or more. So that's what it looks like for the past 6 months. Let's see what it looks like for the past year. And while we're waiting for this, we didn't need to wait for it to load. We see here when it did well, when it fell behind, and let's pull this back to 2017. While we're waiting for this to load, I do want to remind you that this is something that is available to Sectors Made Simple subscribers. It is our goal to not only give you market analysis tools, but tools to create trading strategies as well. So this is a great resource for finding and building your strategies. And if you are not already a subscriber, now is a great time to join in. We have a promotion going on that if there's a lovely person in the Sectors Made Simple community that has a coupon code. If you use their coupon code, you get $100 off your first year subscription, and they get a free tablet. So if you're interested in joining Sectors Made Simple, this limited time offer is your opportunity to join in at a much better price and help a member of the community get a tablet as well. I'm going to test this last strategy. Can we do it with positive only without the momentum? Yes, we can. So we could go here to positive trend, let's say 6 or more, and rebalance every week. And we're still investing in the top 3 sectors here. Let's see. All right, so that is how that strategy would have done. Let's look at how it would have done in the past year. So this is why backtesting is fun, but is also important, is it lets you find the strategies that work. Kike, this backtesting is only for the sector ETFs that we look at for the matrix, because we're using this entire backtesting is using information from the matrix, and we only collect information and do relative strength for the matrix itself. You can change it to 1 or 2 sectors for the past 3 months. Okay. So 1 sector, let's go past 3 months. Let's go past 3 months. There's that. So yeah, someone just put their coupon code in the chat. So if you're interested in joining Sectors Made Simple, use that coupon code when you check out for $100 off. But this is, for many of you, the first introduction to trading strategies and to backtesting. And for many of you, hopefully this is not the last time. Building strategies is important and is a very valuable way to get that informed opinion, something that is based in information and data to help you invest with a little bit more confidence or just a little bit faster. These trading strategies can be done in minutes, so if you don't have a lot of time to invest but still want to make an informed investment decision, creating a trading strategy that lets you invest your way is a great option. It's not the only option, but it is a great option. So I hope all of you have learned a little bit more about trading strategies, where they're great, where human knowledge can pick up on some of the less great things, but how trading strategies are a very important part of the matrix, of analysis, but of investing in general, and how trading strategies make investing simpler. Thank you all so much for joining today's webinar. I hope everyone enjoyed themselves, and I hope everyone has a fantastic weekend. Stay safe. Members, we'll see you on Tuesday for a very, very fun webinar. And for everyone else, hopefully we'll see you next Friday for another free lesson. Thank you all so much for joining us today, and I look forward to seeing you all very, very soon. Take care, everybody. Bye.